Most crypto investors don't lose money because they pick bad projects. They lose money because they don't know what to check before investing. In this final video of our Tokenomics series, you'll get a complete framework you can use to evaluate any crypto token before you risk a single dollar. By now, you should understand the core concepts: token types, supply and inflation, distribution and vesting, utility, value capture, and DeFi incentives. Today, we bring it all together into a practical investor checklist. Let's start with the major tokenomics. Red flags you absolutely must watch out for. Red flag number 1 is a low circulating supply, paired with large future unlocks. When most of the tokens are still locked up, the price can look artificially strong, and the market cap can seem much smaller than it really is. But those future unlocks bring dilution, flooding the market with new supply. Always check the future supply schedule, not just today's price. Red flag number 2. Excessive insider allocation. If a huge portion of the tokens are given to the team, venture capital firms, or early advisors, retail investors often become their exit liquidity. It's a classic setup. Long vesting schedules can reduce this risk, but short vesting schedules are a massive warning sign that insiders might dump on the market as soon as they can. Red flag number 3 is inflation-funded rewards. If staking rewards are mostly paid out by creating new tokens, it's a treadmill to nowhere. The supply constantly increases. The value of each token gets diluted, and the price will struggle to go up over the long term. Any inflation must be justified by real, tangible growth or a critical need for network security. Otherwise, it's just a hidden tax on holders. Next up, red flag number 4. Utility without any holding incentive. If a token is designed to be used for a transaction and then immediately sold, its utility doesn't translate into value. In fact, high usage just increases the token's velocity how fast it changes hands, which puts downward pressure on the price. Real utility must encourage people to hold the token, not just spend it. Red flag number 5 is a big one. High yield without sustainability. When you see an extremely high APY, your alarm bells should be ringing. It usually signals aggressive token emissions designed to attract short-term mercenary farmers. Take Comey and drain the rewards, and leave, causing long-term price decay. Remember this: forever yield is not the same as profit. And finally, red flag number 6. Weaker symbolic governance. If a project's governance system has low participation, is completely controlled by insiders, or the votes don't actually affect the protocol's value, then the governance token itself has very little investment value. It's just for show. Okay, now that you know the red flags to avoid, let's build your investor evaluation framework. Before you invest in any token, you need to walk through these 6 critical steps. Step 1. Understand the token's fundamental role. Ask yourself, what is this token actually for? Who really needs it? And most importantly, can the platform function perfectly fine without it? If the token is optional or just tacked on, its long-term value is likely weak. Step 2. Analyze the supply and dilution. You need to check the total supply, the current inflation rate, and the unlock schedule for the next few years. Ask yourself, how much new supply is going to enter the market over time? And can the demand realistically absorb all of it? This is where many investors get burned. Step 3. Examine the distribution and vesting schedules. Look for projects with a reasonable team allocation, long vesting periods of at least a few years, and fair incentives for the community. You want to avoid projects where insiders can cash out early and leave everyone else holding the bag. Step 4 is to evaluate the value capture mechanism. This is crucial. Ask, how does demand for the token actually increase as the project grows? Do token holders benefit directly from that growth? Is the value created shared with them, or is it extracted by the team or other players? Growth without value capture does not reward investors. Step 5. Review the incentives and the behavior they create. Ask, does staking reward long-term holding or encourage quick selling? Does using the token reduce its supply through burns, or does it just get recycled back into the market? Is the token's velocity controlled in any way? The incentives shape user behavior, and that behavior is what ultimately shapes the price. And step 6. Stress tests The tokenomics model. Use your imagination. What happens if the juicy incentives are suddenly removed? What if market conditions turn bad? What if the project's growth slows down? If the token's value collapses under a bit of stress? Its design is fragile and not built to last. Now, let's talk about mindset, because this is just as important as the checklist. Smart crypto investors avoid hype. They respect the power of dilution. They track incentives relentlessly, and they focus on long-term sustainability. They don't ask, how high can this go? They ask, who wins if this project succeeds? Tokenomics gives you the answer to that question. So here's the final message I want to leave you with. Crypto rewards understanding, not blind optimism. Applying this tokenomics framework won't guarantee you profits, nothing can. But it will absolutely protect you from the most common and costly mistakes that wipe out most investors. If you consistently use this checklist, you'll already be far ahead of most people in the market. They're chasing narratives. You'll be analyzing fundamentals. If this series helped you understand crypto tokenomics from a real investor's perspective, please consider subscribing to the channel. Feel free to revisit the earlier videos in this series whenever you're evaluating a new project. The fundamentals don't change, even when the market hype does. Thanks for watching.